Hello, everybody, and welcome to the Middle Class Investor. This is Seth Martin, your host. It is Saturday, August 27th, and we're looking at a chart of the SPY. I'm going to switch over to the SP 500 just because I have additional things drawn there. But you can see here that we had a down week in the S&P 500. And it looks like it does look like we closed the week lower than the previous week's low. So that usually portends some additional selling. Now that doesn't mean that we couldn't open up a little bit, run up and then sell off. But I don't know. I'm looking for the market to kind of pull back into an area around here, and then maybe go on up and make a new high. Now, if we break through this, if we break down through this, then what I'm looking for, you might get something down here, and then a retest underneath, and then I'm looking for something down below this low here. So those are the two different scenarios I'm looking for. It really just depends. I don't know. To me, this looks unfinished here. This run up it looks finished here. But if you were kind of looking in terms of, 5 waves, which is normally what you have in an impulsive move, you can see here that we would have one more down and then one more up. So. But there are two possibilities, and there's no way to really know. You just have to, if you're short here, if you're already short, you want to try to, maybe look at selling here. If it goes down through this, then you want to look at selling on the retest underneath the pattern here, and then lower. So anyway, that's kind of what I see in the S&P 500. We talked about it last week, but we've had 1, 2, 3, 4, 5, about 5 or 6 weeks or so in here where the market's really just traded sideways, really. The Fed came out and said something the other day. To be honest with you, I don't even know what they said. It doesn't really matter what they say. I know that's a differing opinion than what a lot of you maybe used to, or you think is important. Maybe you disagree with me on that, but the Fed is fast becoming irrelevant in this whole scenario. They're probably, they're still worth talking about, I guess, because a lot of people are talking about them. But the things that they're doing, the things that they can do, are just, there's just not a whole lot of options for them, and so in my opinion, they're becoming somewhat irrelevant. Let's look at the volatility now that we've looked at the S&P 500. Volatility picked up a little bit, obviously, because the market sold off, but volatility is still very low. In fact, I got to zoom in just to get it on the screen here so you can see it. You can see here volatility picked up, which is what you might expect in a down week in the market, and put us right back into the lower part of this range here. Like I said, next week you could get the market could rally a little bit. Volatility could come down into the body here, and then likely take off even higher. So the main thing to say about volatility here is just when volatility is this low, the odds are, the probabilities are that the market has to have some sort of pullback, even if it's going to continue higher. So go back to the S&P 500 just for a second. Even if this market's going to go higher from here, it's got to at least pull back you know, to like here first, or it's got to pull. It doesn't have to pull back to here. It can pull back to right here, but it's got to pull back some in order to relieve that low volatility. That's just the way the market works. I mean, you go up, you go down, but it, it it traverses in a direction, but it does it so by going back and forth, by going up and down, and over time, you know, the general trend is up or the general trend is down. Let's look at 10-year Treasury yields. This continues to be an important market. I think people should be focused on, maybe even more so than the general market. You can see we hit lows on yields back here when the market pulled back recently. Well, I say recently, back around the Independence Day holiday. We had that pullback in the market, and then the market's been rallying, and so have yields. Yields have so far that's been a bottom down here in the interest rate market, and ever since then prices have been going up, just like the market's been going up. But notice now we had a down week in the market. So last week was an up week. Remember, I showed you just there was a whole bunch of chop. We just looked at the chart, and I showed you about 5 or 6 weeks worth of chop. And here you had this one big up week that kind of followed the direction of the market, right? So the market really rallied hard. When I say the market, I'm talking about the S&P 500. So the S&P 500 rallied really hard. Well, so did it rallied really hard in the face of a bond sell-off, okay? And then bonds rallied a little bit, yields fell, but it really just chopped. And now you can see we're starting to get out of that range right here. You can see it's just poking its head up above that range. And oddly enough, this up week on yields or down week in the bond market is corresponded with a down week in the market. And this is different. This is a change. This is a change in what has been happening. So I just want to call your attention to that. It could mean something. It could mean nothing. But these are the types of things you look for in the market to help you kind of predict more meaningful potential turns and things like that. Let's look at the really short-term yield, the 13-week Treasury. This is the one that I've been telling you we use to determine whether the Fed's going to raise rates. And obviously it was up as well. And I still say that if we get above, if the market, if this particular market, this 13-week Treasury market pulls above here and maybe retests this line and is staying above this line, the Fed's going to raise rates, no doubt about it. I don't care if the economy's bad, it doesn't matter. They're going to raise rates because the perception that they want to continue to put out there is that they're in control of interest rates. And obviously, if interest rates are taking off to the upside and the Fed hasn't raised rates, people are going to start to question that. And what is the Fed? What control does the Fed really have over interest rates? And they're going to, and what ultimately this is going to be ferreted out in the media, and ultimately we're all going to find out. It's going to be very obvious to everybody that the Fed does not set interest rates, because at some point, as they continue to raise rates with the economy crumbling, they're going to come under criticism. They're going to say, why are you raising rates with the economy crumbling like it is? Well, you need to be lowering rates, not raising rates. And what's going to come out eventually is that they're not in control of rates. Okay, something that I say most people, a lot of people already know, but the financial media doesn't know that, and it's just not something. They either don't know or they're playing along that the Fed has more power here than it actually does. So I realize that may sound controversial to you, but you can go back and study it yourself, and you'll find out that is the case. I guess since we're talking about yields and stuff, we can look at the 30-year Treasury too. The 30-year Treasury was up this week as well, but obviously not as much for whatever reason. And it's still kind of in this, let's call it chop range right through here. So I think you'll start hearing more in the financial media and on the news if interest rates kind of break out of this range, and more importantly, if the short-term rate begins to move in a meaningful way. Global markets are really very down. They haven't hit new highs like our U.S. market has. So it's increasingly probable that the U.S. market is the last market, hanging in there. Excuse me. And one of the things I want to point out is in this global Dow. Global Dow is just it's an index for kind of all the global indexes. But one of the things I want to point out is this move up is very corrective looking, and you can see that it's starting to look a little tired. You get when you start getting these dojis. Dojis are real little body candles. So this is a little body. This is a big body candle right here. These are big body candles. But when you get these little body candles with wicks on either side, and notice I've got a DP resistance area right here, and that's happening at this DP resistance area. And I don't know when I put this up here. It was some time ago. We don't even look at the GDOW that often. So this has been up here for some time. But a couple things. One, we're at this DP resistance area. This is the 62% retracement area. The global Dow looks like, in the next several weeks, it could roll over and start going down in a pretty meaningful way. And if this was the high and this was the first move down and this is the first correction, that means this next move could be substantial. So just be aware of that. You've all got 401ks, you got money that you're trying to grow, and you probably aren't looking to give any back. And so we've talked about some of the things that are going on in the global markets, like Deutsche Bank, the Italian banks. This worldwide banking system could lead to a pretty big crisis. So, and that would be that would manifest itself throughout the financial world, not just European community. So, anyway, just keep that in mind. More and more we have to be aware of what's going on globally with respect to our money, because all these institutions are connected to one another, and it is true that these companies aren't just going to crumble up and quit doing business, but the credit markets and stuff that all these companies depend heavily on credit, consumer credit, commercial credit, things like that. And if you start having a huge disruption in the financial market, these stocks are going to go down just because their access to credit, or the expense of credit, is going to impact their businesses in a negative way. So that's the link. Okay, it's true that General Motors is still going to produce cars, and it's true that Hershey's still going to make candy bars, and all these companies are going to do what they do. McDonald's is still going to sell the Big Mac and fries and coffee and whatever else they're selling, but their ability to expand, their ability to maybe they might even have to contract, maybe close some outlets and things like that in order to work with their own cash. They might have to raise cash if they don't have access to credit. And of course, if they close and lay off people and stuff like that, that's gonna cause a contraction in their business. So that's how the financial stuff reflects in the real, let's call it the real market, okay, the market of goods and services. That, in fact, the market of goods and services in the stock market, that's how they're linked, is through these financial markets. So let's see, what else can we say about, we can look at the Russell real quick, just look at some of these other markets. The Russell, it's got some dojis and stuff happening, probably some pullback. I've been saying this for, I don't know, several weeks now, that we've got some pullback in our future, and it just keeps kind of grinding higher here. Last week we got a higher high, but then sold off. That's pretty bearish in the Russell, but it's still kind of in this range, right? So what you want to see is if this is going to pull back, let's say down to there or whatever, then what you want to see in the Russell is you want to see maybe a candle that looks, next week that looks like that, where this low is lower than this low. And then that usually is going to tell us, even though the next week might be, like this, it's probably going to tell us that we've got one of these in our future, and maybe a couple like that, okay? And then maybe something, like so. This is kind of the way the market does, and then kind of does like this, okay? So, but we want to see the market stop going up first, and a good way to do that is focus on this low of the high week, and we want to see it close below that. All right, let's see, what else could we look at? We could look at the Wilshire. The only thing I don't like about looking at the Wilshire on this particular charting tool is you get all this bad data, like this right here. This is not real. So I don't really like looking at the Wilshire on profit charts. Look at the NASDAQ composite. Same kind of thing as the Russell. You got a couple dojis there. Here's a classic doji. Usually stops a trend cold, but this one, you can see the high went a little higher and the low went a little lower. That's very similar to what we had in the S&P 500 last week. In fact, let's go back and look at that. So what I'm talking about here is this high is higher than this high, and this low is lower than this low. So let's go back and look at the S&P 500 real quick, and I'll show you how that happened last week in that market, in that index. If I can get that to, there we go, click. Yeah, it's very subtle, and a lot of times these things are real subtle. But you can see that this high is higher than this high. So you got to kind of put this week out. Just don't think about this week. But this high right here is higher than this high, and this low is lower than this low. And this usually will tell you that there's the trend is coming to an end there. Now, we did, this wick got up pretty high. It almost made a new high, but then you can see the bears pushed it down and closed it right here. So now it looks like maybe that I'm looking at this, it didn't actually close below this low. So there's still a potential for some bullishness. I mean, we might get a candle like this next week, and then maybe the following week we get some downside action. I don't know. We'll just have to wait and see. But I just noticed this close is not below this low here. But mainly what I wanted to show you is how this pattern happened in the NASDAQ this current week. So it's kind of the market softening up one index, at a time. I guess we can look at Japan, and Japan, I mean, I don't know what's going on with those people. They think that, so let me just say that everybody in the world, all the people leading all these countries all over the world, believe that consumer spending is the key to the economy. Consumer spending is not what causes growth. It's a byproduct of growth. So it's a byproduct of a healthy economy. The problem is they have this thing. These people have this flipped on its head. They say, well, if we can get consumers to spend, we'll have a healthy economy. But that's not true. What you have to have is you have to have an economy that produces goods and services, employs a lot of people, and then those people spend. That's the order of operation. It's not let's all spend and then that'll create a healthy economy. That's not how it works. But this is the way they talk about it. And so you've got Japan just going completely crazy. I mean, they're buying $1 trillion a year worth of Japanese bonds, and then with printed money. So they're creating money out of thin air, buying Japanese bonds to keep interest rates low, so people will borrow money and spend. Well, that does not make a healthy economy, but this is the way these guys think, and it all comes from this Keynesian kind of. It's really not Keynes. It's really not what Keynes said. Keynes said something similar, but he prefaced it with, he didn't really say it made the economy healthy. He said it would slow down like a collapsing or a economy in a recession. So these are not things you do during non-recessionary times. And some people would argue that you don't do them at all, but that would include me. But it's just interesting how they've flipped this whole consumer spending thing on its head. Consumer spending is a feature of a healthy economy. It's not the cause of a healthy economy. The cause of a healthy economy is lots of people are starting new businesses. People are employing people. There's just a lot of production, a lot of goods and services being produced and exported and imported, and you just have, in fact, you want to have a healthy economy is representative of low debt, so not massive debts and deficits and stuff like that. So anyway, what you've got is this inflationary kind of thing happening in Japan. So yeah, I mean, if the government destroys the money, everything denominated in that money is going to go. It's going to be perceived as going up in value. But really what's happening is the money just buys less. So if McDonald's is $100 a share, and I take the money and I destroy 20% of its value, well, now McDonald's is $120 a share. So that's how that works. Same thing with food and gasoline and just all goods and services. There is no way. The only way we become wealthier as a people is by producing more, which then lowers prices, right? Because if you produce more, then every unit of production costs less. Well, because it costs less, people can spend more on other things. And then the more goods and services that you can produce and demand in an economy improves everybody's standard of living. Just if you didn't increase production of anything and you just added more money to an economy, everything would just be more expensive. It would just take more of those dollars or yen or whatever to buy the existing things that are in the economy. So these are just fallacies that people are adhering to and living by. And I don't know why this is being learned. I don't know why. I mean, I'm not even an economist, and I understand this. So I don't understand how people who are trained economists don't understand these relationships, these real relationships. So you can see here, this is Germany, and see I've got this downtrending channel drawn. I don't know when we drew this. It's been on here a long time. But look at where it's turning right there. Boom, right at the top of that channel. So now it could just pull back. Maybe it pulls back to here and then breaks out, but I don't think so. I think this channel is gonna continue to be a good place to look to short Germany. So, and that's evidenced by the global Dow. I think, if you look at just every market in the world is down, really, except the U.S. market. So, I think if you want to short the DAX, at least down into this area, then I think this is a good place to do it. Now, it might actually, let me make a little caveat here. It could, you could get a slight new high here, and then down, okay? But that's trading, that's investing. I mean, no, you don't know, so you have to kind of take your signal and get in. And then if you get a close above these highs, then you get out and you try again later. You try again at another date. Let's switch over and look at the dollar. Here's the dollar. So back in 2000, the dollar slid all the way down to the 2008 financial crisis, and then ever since then, the dollar, well, it rallied, it fell back, it rallied, it fell back, and then it really took off here. Now we've been chopping sideways, and I was suggesting last week that this sideways chop should just about be over. In fact, I do think it's over, and once the dollar clears this level right here, I think for sure we'll know it's over. And I would look for the dollar to get up to this 102, 103, 104 area. Now, while it's doing that, excuse me, while it's climbing up into that area, I think you're likely to see gold and silver go down. So let's look at gold. You can see gold is starting to look a little soft here. And I think you're likely to see gold over the next few months, traverse its way down into this area below 1200. And this would be a good place to buy some more gold if you're looking for the physical metal, because after this, we'd probably have a run up into this 1500 area, something like that. Now, if you've been listening to my program for any time at all, you know that I think gold is ultimately going to go down here below $700. And I've spoken about some of the challenges of waiting till then. You can wait till gold goes that low and then buy a bunch, but there may be problems with actually getting gold. There may not be a lot being produced at that time. And governments might be buying more gold. I mean, they might be scarfing it up. So there could be challenges with waiting until you get down here. Now, I mean, the reality is I don't really know. I mean, there's no way to know. I mean, really, I think where we're headed is, our country has not really experienced this before, so it's hard to know exactly how that's going to play out. So everybody gets to make their own decisions, but in silver, I'm looking for silver to come down here below $8. So same kind of deal. Now, silver's pulled back a little bit more dramatically, and this is one of the reasons I think gold is probably done for the time being and is traversing its way, down into this area along with silver. So anyway, I hope that clarifies things for everybody. The euro, you can see the pattern that we've been expecting on the euro. The euro is pretty much following that. It didn't come all the way down to this area like we thought it was going to. And as a result, maybe this pattern is not what's unfolding here, but we did get kind of an inside week. So if we get a close next week below this red candle here, then I think you could probably say the euro is going to be breaking out of this. It's going to be breaking out of this support line here and going lower. probably down there toward parity, with the dollar. So we've been talking about that for a really long time too. The Japanese yen, I mean, the yen should be, as you can see here, there's a DP support area, really good support too. I mean, just look at all these weeks here where it chopped around and got a pretty good, excuse me, I apologize, I got a little tickle, but we got a pretty good little buy signal going on right here with the yen. You've got a low, you got a higher low, and now you've got a close above the high of this low. So I would look for the yen over the next month and a half or so to move into this area, and this would be a good place to stop your trade. So buy here, sell in this area here. So what is that, 108 maybe? So right now we're at 101.81, so that'd be a pretty good trade on the yen from 101.81 to 108. Let me take that off. That's really cluttering this up. So let me draw a box on there just to help everybody see. In fact, let me just move this box. Okay, so I would look for the yen to move into this area. And again, that's right at 108. So now you can trade the yen. I think it's JPY. No. Well, shoot. I don't know what it is. But you can go online and you can look for the ETF for the yen dollar. And it might be a good time to buy some here. And in fact, a lot of times on this let me zoom in here and talk about this for a second. A lot of times on this initial breakout candle, like you've got right here, we might actually get like a pullback into the body of this candle, like so. So you might actually be able to, if you're really confident in this signal like I am, you don't need to buy above. Once this signal is giving you a signal, you can actually, if the market pulls back, you could actually just buy right here, okay? You don't have to buy above this candle. It's already signaled that you can, that this is a fairly low risk entry. Now, if you bought right here and it moved down here and closed below here, then you're out. You lost money, okay? But if we get a pullback next week, you can actually buy the yen down here a little lower, and then your reward is even that much bigger, right? So anyway, when I see something like this in a really good time to enter, I want to make sure I spend a little extra time on it and tell you about it so that you can take advantage of it if you want. Now, at the end of the day, it's your decision. I'm not making a recommendation. I'm not, I don't sell any securities or anything like that. So these would have to be your decisions, your money, your decision. Okay. Let's look at crude oil. A lot of talk about crude oil. Very interesting market. A lot of other markets, a lot of misinformation, a lot of confusion about supply and demand and things like that. So here you've got you got this initial run down. Now we could get another move up into here and then down. I mean, that's very, very possible. Okay. But you're also at a junction in crude oil. Whereas if next week, let's say we get a close below this low here, the reason, see, this is the high bars right here, but this second bar, this red one, has closed almost entirely inside the green. So then what you do is you look for a close below that low, okay? And then you can, that's a fairly low risk entry point. and then you would expect crude to move down, maybe down here below 40, just below 40. Now, maybe what happens is it moves down here below 40, and then it goes a little higher like this, okay? But there's no reason why you couldn't trade it from here down below 40, and then once it hits kind of a support under this pivot right here, see there's a pivot right here. Once it hits support on that pivot here, then buy crude oil right here and trade it up to this area, kind of like where the yen is, So I think this is probably likely. Now, a lot of people think that crude oil is just going to trade sideways for a while, and that could be. So, I mean, I'm not saying they're wrong. I'm just saying there's no way to know for sure. Let me zoom in here and I'll show you a possibility. But if it does trade sideways, what's likely to happen is it's likely to trade sideways in a triangle, like so. Okay? So you might get, it comes down here, it bounces here, and it bounces here. And these are generally, so there's, A, B, C, D, E, and then there's one more move up. Okay? And then you get a sell-off. Okay? That's how the market tends to move. So if it does in fact trade sideways for some period of time, it's likely to follow some pattern like that. In which case you could sell right here, buy it back here, sell here, buy here, so on and so forth. Except when you buy here, you don't want to be a seller right here. You want to, it's going to break out of this pattern at that point and go to highs. And there's a gap back here, so maybe that's a viable. It could be a viable deal on crude oil. So certainly, if we sell off here and we don't break this low, then that increases the odds for a triangle. So just keep all that in mind for those of you who are interested in trading crude oil. I'm gonna pull the Wilshire up here because the Wilshire doesn't have bad data. Well, I don't know. Here's some. I guess that's bad data, but you can see here on the Wilshire, we had a similar phenomenon that we did on the S&P 500, with this outside, here was the high. So if you were just looking at this candle, the next week we had a higher high and a higher low. And again, this particular kind of situation usually means that you're going to get some selling. So we did get some selling this past week. And if we close below this low, so if next week looks like that, then you could see these pick up a little bit, and you could see the Wilshire sell off a little bit more dramatically. And the only reason I say it would be more dramatic is because the next pivot is way down here. There's not a pivot until you get down to this area, right? So that, you could pull all the way back to here. So just keep all that stuff in mind. We're at a place. The market's been really weird. It's just been, the range has been like super low, like 5 for the last 6 weeks, and it's just a very difficult trading environment. Now, I will tell you what I told somebody the other day. I was talking to somebody. Let me go back to the S&P 500. And I've talked about this before, what I'm about to say. But if you're in a 401k, okay, and you're trying to decide, is there more upside? Is there more downside? You have to learn how to think in terms of probability. So we've had this pretty dramatic run up since February, boom, all the way to here. Well, we had one here, then we had a pullback, right? And then this has been a pretty dramatic run up. See, notice how this has a certain length and this has a certain length. So this is part of. So you had a pullback here, right? You're gonna likely have a pullback here, and then look, this next run up will likely be shorter too. So this has a length. This has a shorter length. This has a shorter length. So you can pick these things out in the market really easy. If you just learn to look for them. But what I was pointing out to this person I was talking to the other day is when you have a low range like this and you're right at the top of a trend line, and is it more likely, let's see what, like, I'm here to make money, right, in my 401k. So, what's the likelihood of this going up another 5-10% from here, from where we are right now? Well, it's not very likely, right? I mean, you just look at these moves, these pullbacks. So, so let's think of this. Let's look at it this way. Let's say, let me not do that. Let me get a little bit more space here. So let's say this is my reward, from here up to here. What's the risk? The risk is from here down to here. So if you're in a 401k and you're looking at a situation like this, I mean, this is maybe a place where you say, yeah, I think I'm just going to go to the sidelines. Because, yeah, it could just pull back to here. That's fine. But it could pull all the way back to here, in which case I just gave half my earnings away for the year. So, maybe when you see something like this, you step to the sidelines, you let it pull back, you let it see if it's going to pull back to here, or if we get a bigger pullback to here, and then make another decision. I hope that doesn't confuse everybody, but my point is there's just not that much reward here for you to get if the market does decide to go higher from right here at this point. There's just not that much reward. There's a lot more risk, okay? And that's kind of the way, that's a good way to think about in your 401k is just think about what's probable. You've had this big run up, pullback, a little bit smaller run up. I think a pullback's really probable, but then a bigger run up is not very probable. So I don't know, it just takes some practice, but I'm just trying to give you a little insight into kind of the way I think about it and the way a lot of successful traders think about trading the market. So, all right, everybody, that is it for the week. Appreciate you coming in. As always, if you'd like to make comments, just make comments here on YouTube, or you can go to @InvestorClass on Twitter and follow me and make comments there. Tell me I'm a doofus, or I don't understand economics, or I don't understand markets, or just whatever you want to say. If you want to say some good things, that's okay too. All right, everybody, that is it for the week. Thanks for coming in, and we'll talk to you next week. Bye-bye.